Welcome to How to Beat the Stock Market, uncovering hidden profits with Joel Greenblatt's genius strategies, bringing you a deep dive into the world of unconventional investing. This summary is based on Joel Greenblatt's classic book, You Can Be a Stock Market Genius, first published in 1997. Whether you're a beginner or a seasoned investor, you're about to discover how to outsmart Wall Street and build wealth, one smart move at a time. Let's get started. Chapter 1. Why Traditional Investing Falls Short. Picture this. You're up against Wall Street's elite, billion-dollar fund managers and freshly minted MBAs. Sounds intimidating, right? But here's the secret Joel Greenblatt wants you to know: traditional investing gives them no edge over you. Let's break it down. First, there's the myth of the efficient market. You might have heard that stocks are always priced perfectly, reflecting every bit of public info. It's called the efficient market hypothesis, or EMH. Professors love it. They say you can't beat the market without luck. But Greenblatt? He calls it bunk, at least for the little guy. Sure, giants like Apple might be efficiently priced, but the market's messy corners? That's where the pros stumble, and you can shine. Take a fund manager overseeing $12 billion, let's call him Bob, like Greenblatt does. Bob's got a problem. To spread that cash across 50 stocks, he's dropping $240 million per pick. With only about 800 US stocks worth over $2.5 billion, he's stuck with the big, obvious names. He can't touch small companies or weird securities without shaking the market. Plus, his boss checks his returns every quarter. No room for patience or creativity there. You, though? You're free. With $10,000 or even $100,000, you can zero in on a few hidden gems, wait as long as it takes, and dodge the spotlight. That's your advantage. Greenblatt shares a story about his in-laws to drive this home. They're antique hunters, scouring country auctions for bargains. Their trick? They don't guess trends, they just check if a painting or chair sells for way more elsewhere. It's simple: buy low where others aren't looking. In stocks, that means special situations, corporate shakeups the pros ignore. More on those soon. Chapter 2. The Basics: 6 Rules to Live By. Before we hunt for profits, Greenblatt lays out 6 rules in Chapter 2 of his book. Think of these as your investing toolkit. Ready? Here they are. Rule 1. Do your own work. Nobody's handing you a treasure map. Special situations, like a company splitting up, don't make headlines tailored for investors. You've got to dig into filings and numbers yourself. It's work, but it's how you stack the odds in your favor. Rule 2. Don't trust anyone over 30 or under. Stockbrokers? Analysts? Forget me. Greenblatt says their track record stinks. Brokers push buy to earn commissions, and panning a stock cuts them off from company insiders. Even the good ones don't explore the weird stuff. Trust your own brain instead. Rule 3. Pick your spots. Ever hear Warren Buffett say, swing at one of 20 pitches? Greenblatt agrees. Don't bet on every stock. Wait for the perfect shot. A few killer ideas beat a dozen SOSO ones every time. Rule 4. Don't buy more stocks, put money in the bank. Scared of risk? Don't water down your best picks with extra stocks. Keep cash in safe spots, like a bank account, to handle life's curveballs. Focus your stock money where it counts. Rule 5. Look down, not up. Forget chasing the next Tesla. Greenblatt channels Benjamin Graham: buy cheap, with a margin of safety. If a stock's so discounted that even bad news won't sink you, you're golden. Risk isn't ups and downs, it's losing for good. Rule 6. Stay disciplined. Panic selling when the market dips? That's a rookie move. Stick to your plan, and let your research guide you, not your gut. These aren't fancy, but they take grit. That's your edge over the herd. Chapter 3. The Secret Hiding Places of Stock Market Profits. Now, the good stuff. Where to find those profits. Greenblatt's all about special situations, corporate events that mess with stock prices, creating bargains. Let's explore his top 6 strategies, with real stories to back them up. Strategy 1. Spin-offs, the golden goose. Imagine a company splitting off a division into a new stock, like a parent giving a kid their own place. That's a spin-off. They're messy, but Greenblatt says they're gold mines. Why? Big investors dump shares they don't get, insiders grab stakes, and the new outfit sharpens its focus. Studies show spin-offs often crush the S&P 500 in their first couple years. Take Host Marriott in 1993. Marriott Corporation split into 2. Marriott International for hotels, and Host Marriott for real estate. Host got saddled with debt and lawsuits, trading at just $4 a share. Scary, right? But Greenblatt saw its properties were worth way more. A year later, the market woke up, and hosts soared. How to win? Check SEC filings for asset details, watch for insiders buying, and love leverage if the business can handle it. Strategy 2. Partial spin-offs and rights offerings, hidden gems. Partial spin-offs are trickier. A company spins off just a chunk of a subsidiary, often with a rights offering a chance to buy more shares cheap. These stocks start illiquid, ignored by big funds, and that's your opening. In 1991, Telecommunications spun off 15% of Liberty Media, its cable programming arm, with a rights deal. Liberty hit $128 a share, way below its value, because Wall Street balked at the complexity. Greenblatt pounced, and it tripled as the truth came out. Your move: dig into the assets, jump on rights offers fast, they've got deadlines, and wait for the crowd to catch up. Strategy 3. Risk arbitrage, betting on mergers. Risk arbitrage sounds fancy, but it's simple. Buy a stock after a merger's announced, betting the deal closes at the offer price. It's a race, but Greenblatt shows you how to play. Back in 1985, Harcourt Brace Jovanovich offered $27 a share for Florida Cypress Gardens. The stock sat at $24, regulatory snags spooked folks. Greenblatt figured a 90% shot at success, nabbed a 12.5% gain in months when it closed. Sweet, right? Tips: size up the deal's odds, regulation, cash, intent. Skip shaky ones. And look at merger securities, like stocks or warrants, for extra juice. Strategy 4. Bankruptcy and restructuring, diamonds in the rough. Bankruptcy scare most people off. Chapter 11 sounds like doom. But Greenblatt sees treasure. Distressed stocks, bonds, even trade claims can pay big if you're smart. Charter Medical, a hospital chain, hit bankruptcy in 1992 after a botched leverage buyout. Its stock dropped to 75 cents. Greenblatt spotted its cash flow potential post-restructuring, bought in, and watched it climb to $20 in 2 years. How to cash in? Study the bankruptcy plan and SEC filings, focus on future cash, not past flops, and grab orphan equities dirt cheap. Strategy 5. Recapitalizations and stub stocks, leverage unleashed. Recapitalizations shake up a company's debt and equity, often leaving stub stocks tiny equity slivers after big borrowing. They're cheap, leveraged, and explosive. FMC Corporation did this in 1986. It handed out cash, leaving a $5 stub stock. Greenblatt saw its assets and cash flow screamed $20. 18 months later, he was right. Your play: check if the company can handle debt, value the stub beyond its puny cap, and bet against Wall Street's leverage phobia. Strategy 6. Leaps, warrants, and options, turbocharging returns. Want to supercharge gains? Leaps, long-term options, warrants, and calls let you bet big with less cash. They shine in special situations. In 1990, Wells Fargo crashed after a real estate scare. Greenblatt knew its loans were solid. He bought 2-year leaps at $8, strike price $80, with the stock at $78. It doubled to $160. His $8 turned into $80. That's a 900% pop. How to use IM. Pair with spin-offs or restructurings. Don't overpay, check value, and cap your risk to what you put in. Chapter 4. Your action plan. So, how do you pull this off? Here's your 5-step plan, straight from Greenblatt's playbook. Step 1. Find opportunities. Read the Wall Street Journal, hit up SEC's Edgar site, or grab newsletters like Outstanding Investor Digest. Look for spin-offs, mergers, bankruptcies. Start with Greenblatt's examples, like Marriott or Viacom. Step 2. Do your homework. Learn balance sheets, income statements, cash flow. Chapter 7's your guide. Compare market cap to real value. Check insider moves and proxy filings. Step 3. Pick your spots. Stick to 5 to 8 stocks. Greenblatt says their swings, say, minus 11% to plus 31% a year, aren't much wilder than the S&P's minus 8% to plus 28%. Be patient for the payoff. Step 4. Manage risk. Keep cash in the bank for emergencies, not more stocks. Buy with a safety buffer. Sell when the gap closes, not on a whim. Step 5. Learn and adapt. Read classics like Graham's Security Analysis. Start small, track your wins, and tweak your game, or watch our summary. Chapter 5. Proof it works. Gotham Capital. Greenblatt's no theorist. His fund, Gotham Capital, turned $1 into $51.97 from 1985 to 1994, 50% a year after fees. Compare that to mutual funds, lagging the S&P by 1% annually. His secret? Special situations the pros can't touch. Chapter 6. Watch out for these traps. Before you dive in, dodge these pitfalls. Over-diversifying. Too many stocks kill your edge. Chasing tips, brokers, and hot picks like Greenblatt's Greyhound, Lucky, burn cash. Ignoring risk, leverage, and bankruptcies by it without homework. Impatience. Don't bail early, value takes time. Skipping basics, no financial know-how? You're toast. Chapter 7. The bigger picture. Greenblatt wraps up with a twist. Money's not the end game, it buys time. Time for passions, family, giving back. His strategies aren't about quick riches, they're about steady, smart wealth. Conclusion. Your path to genius. You don't need a Wall Street title to win. Greenblatt's You Can Be a Stock Market Genius hands you the tools, spin-offs, mergers, leaps, and more to beat the pros. It takes effort, but the rewards. Financial freedom, one bargain at a time. Grab the book, hit those SEC filings, and pick your first play. The snowball's ready, give it a push. Thanks for listening. Don't forget to like, share, and subscribe.